the labour market is softening. We have seen an increase in unemployment. If you increase interest rates or decrease interest rates, depending on which lever you're trying to stimulate, they work in direct conflict with one another. So if you're trying to stimulate economic growth and employment, you'll reduce interest rates so businesses can borrow money, employ people and expand. But from an inflation perspective, reducing interest rates increases spending, price of stuff goes up.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back on the audio waves.
Guess who's back? Back again. 360's back. Tell your friends. Anyway,
I was going to let you go. Come on, keep it going.
Karaoke time. Andrew, favourite time of the week. One of your favourite episodes.
And yours, Bills.
And mine too. Talking about a market wrap because it does tell everybody what's been going on across investment markets across the world. So a little bit happening. Andrew, Let's crack straight into it. Where do we start? Start with the US?
Yeah, starting over in the US, we've seen some pretty strong rallying. The S&P 500 gained 3.2% in the last month. So huge rally over in the US. But despite the huge rally, investor sentiment is mixed. There's optimism around rate cuts and earnings, which has been really strong, which we'll talk about a little bit further on in the episode. But there's also some fears around some slowing growth, particularly around AI-driven gains, and that's starting to fade away. But nonetheless. Is that right?
Yeah.
That sounded
That's
right.
right.
It sounded wrong when I said it.
Correct.
The market has been moving pretty significantly upwards over in the States.
It's interesting, right? I mean, as investors, we're always looking for signals. And I guess the more connected and the more complex the world gets, in this political environment and economic environment, there's so much of that going on. But you're kind of going, okay, wow, 3.2% last month. And you're looking at this and going, but there's so much happening. How does that work? And I think it's just a really good indication to say, hey, you've got to separate the noise out from the signal and actually look through what's happening. And obviously there's a bit going on with technology and AI being the next boom and stuff like that. That probably then leads us into inflation. So over in the States, the September CPI's inflation rose 0.3%, with core CPI up 0.2%, which is below expectations. So if you think about where that goes to on an annualized basis, in terms of where their inflation is running, well, you look at our figures, we'll talk about that a little bit later on, but they've got inflation well and truly under control. So when you look at it from that perspective...
No, in fact, it's under expectation,
well,
right?
That then leads into the discussion that we're going to have about the Fed rate cut next. I'll leave that for you to talk about, but inflation is below ultimately where they want it to be, which is perfect for what we were talking about before in terms of where the market goes.
Yeah, and so moving forward, expectation is that the Fed is, or the market's pricing in the fact that the Fed's going to do 2 rate cuts in 2025, considering that we're in November, basically, or at time of recording, just maybe at a timestamp, but we're on the last day of October. So essentially in the next 2 meetings, we're expecting a 25 basis cut next week, and then another one in December is the expectation. So I think that the Fed has now shifted, and now it's no longer a position of, hey, we're trying to keep inflation under control and we're trying to slow things down. It's now, okay, we need to, support growth in the economy. There's some weaker employment data that's been coming out, and, outside of AI-driven sectors, there's, been some patchy growth, to say the least. So they're now not trying to fight inflation, but rather try and spur on some growth, which is usually done when you're talking about things from a Fed perspective in reducing interest rates.
Yeah. Look, that's a really interesting point. I mean, if you consider where they're at from that perspective and just thinking through the stat that you just gave, then you look at the reporting of the S&P 500 companies, around a third of them have reported. 85% of those companies have beaten expectations. This is the best result in 4 years.
Yeah.
So if you think that, a third of them have reported, and that's a big enough sample size to be representative of the group, you look at that and go, okay, 85% of the time the largest companies in America are outperforming where the analysts had expected them to be, is almost in conflict with the stat that you were talking about before. It's a really interesting position. And is it just the big companies just, sucking up all the oxygen, so to speak, and a lot of it's driven by the tech sector?
Or is it just that when you see, companies doing their reporting, if you're looking at positive reporting, you're usually reporting early, so you're representative in the stats earlier on, versus if your reporting is not quite as good, or if your earnings are not, where it needs to be, you're trying to give yourself a little bit more time and essentially you're pushing your reporting back. I don't know, but nonetheless, best result in, 4 years it's a positive figure.
Yeah.
And I think what we're seeing is industries where there's growth, industries where there's no growth, and that middle ground isn't necessarily, happening, which is why you're talking about Fed rate cuts.
Once again, another interesting stat sort of leading into it. If you look at US GDP growth, annualized at around 4%. So it's supported by rising household wealth and resilient spending, but this is from higher income families and households. So credit stress continues to ease, which is great. Bankruptcy filings are declining, which is also great as well too. However, housing, which is such a big part of the economy, remains subdued, and CapEx growth, so capital expenditure for business, that growth is narrow. We're seeing a lot of that money being sucked into AI and all of the infrastructure associated with that. But we are seeing that that the late cycle is starting to recover.
Yeah. Over to Australia, maybe not quite as positive when we're talking about the ASX, but ASX 200 rose pretty much at 0.5%, it's 0.41. Or was at time of recording over the last month. So we saw, a little bit of growth, but nothing to write home about, nothing that's been, significant when we're talking about the Australian economy over the course of the last month.
Yeah, the Australian market is quite interesting. And look, comparing Australia to the United States is probably not a fair comparison. The markets operate completely differently. If you look at the composite of our exchange and the companies that make up the All Ordinaries Index, it is quite heavily skewed to the top 10 companies in Australia. Interestingly enough, when we look sort of what the RBA are doing, because they're really the ones pulling the strings with the inflation lever and what they're going to do from an interest rate setting perspective, household consumption remains strong. Inflation is stickier than forecast, which is a bit of a concern. We just got the statistics out this week, so any hopes of a rate cut for, this year and probably the start of next year have been dashed. If we can't get inflation under control, there's probably even a case to talk about increasing interest rates. But interestingly enough, which is kind of the bit of the conundrum that they're going to need to work through, is that the labour market is softening. We have seen an increase in unemployment. So if you consider inflation high or higher than expected, unemployment higher than expected, if you increase interest rates or decrease interest rates, depending on which lever you're trying to stimulate, they work in direct conflict with one another. So if you're trying to stimulate economic growth and employment, you'll reduce interest rates so businesses can borrow money, employ people and expand. But from an inflation perspective, reducing interest rates increases spending, price of stuff goes up.
Yeah, which look, I guess for the time being, our expectation is probably that interest rates will just stay on hold until there's further data that comes through. That was some of the rumblings that was coming out of the RBA this week after the inflation data came out, in that, they're not going to base their decision on just one data point. But you saw the market completely flip. Before that inflation data had come out, there was about two-thirds of the economists were expecting that there was going to be a rate cut. And then that inflation data came out, and it was two-thirds of economists believed that that interest rates were going to remain on hold.
Yep.
So, I guess, for mortgage holders out there, it's not that it's completely lost and that there's no chance of any rate cut, but I think it's an unlikely scenario. And if you've seen how cautious the RBA has been over the course of the last little bit, I can't see that happening, and it's probably the right call from an economy perspective to keep rates on hold.
I love your optimism, but it ain't going anywhere.
Right.
They're not going to, you don't, unless you've got a really strong case, you don't decrease interest rates because it's so hard to get them back up again.
Yeah, and you're already seeing the impact that it's having on property prices. Yeah. I mean, we're talking about, prices climbing almost 1% across the 5 major cities in October, and that's, 1% in a month. So significant growth in the property market. We've been talking about it for a little while, and that's, kind of met our expectations as to where we've seen, in particular Victorian property prices rise and some strong data coming in, in this spring selling season, which is usually when there's elevated levels of property being sold. But yeah, I mean, I think that when you talk about rate cuts and then you also throw into the mix the additional power around borrowing that the government's given in schemes to be able to allow first home buyers into the market, that is going to, push even more of a fear of missing out. And so what you're starting to see is really the property market rising.
The other thing too, so property market rising, but obviously that's counted in the bucket of inflation as well too. The other thing too is from the government's energy rebate initiatives, that's dropped out of those figures as well. So we've seen a kick with that. Yeah, just thinking through those two things, I think we're going to continue to see a little bit more inflation stay where it's at, potentially. Hopefully it doesn't increase. I'm not as optimistic. I don't think now that those figures have come out, I don't think we're going to see a decrease in rates anytime soon. And maybe we should timestamp it and just have a bit of a friendly wager the weekend before we're recording, which is the weekend before the Melbourne Cup. So we're in the
betting.
We're in the season for it.
Who's going to bet on the other side?
So the bet is, right, and you can choose first which side you want to take. I know, will the next rate move be up or down?
Will the next rate move be up or down? No, I think it'll be down. I don't think they'll rise rates.
As a betting man, I'd prefer to take that just to make it entertaining. And obviously, someone else has to take the other side. I'll take the other side.
All right, good. Nice to know that we bet our houses on it.
Definitely not betting anything more than a cup of coffee, to be honest with you. But Andrew, let's pivot into China. I mean, GDP growth for Q3 grew 4.8%, beat expectations. Obviously, they lead in exports and industrial output. They're just an absolute machine.
Yeah, I mean, look, GDP growth is massive, and a lot of that is in exports. I mean, the domestic demand is still soft. We're still seeing housing prices fall in major cities outside of Beijing and Shanghai. And so China is still having an issue from a property perspective, but from a GDP growth, yeah, I mean, it's still very significant. You talk about those numbers in any other country, and you're talking about a crazy boom. You talk about that in China, and it's beating expectation, but nothing that's setting the world alight. So yeah, very interesting over there. Yeah,
Andrew, from a policy outlook, and I'm throwing that one over to you because I can't read the notes that you've written down there, and I have no idea what that means. So hopefully you can make heads or tails out of it.
Look, I can't, to be 100% honest with you. I was doing this last night. So the major point is that there's still another 2 sessions that are due to happen in March. There's March 2026. So we're still talking about, another 5 months away. And really that's around what impact that's going to have to property prices and how they're going to spur on some growth there.
So is this the policy settings of like they're having 2 more sessions between
now and March and the impact or how much they're going to drive support into the property sector in order to drive growth?
And I think one of the other focuses of that as well too is, and we've seen it across the world with technology, and how does a country become self-reliant on that? There's been a lot of talk in the media of late with all of the rare earth minerals as well too, where you've seen the United States and Australia in particular doing a deal. Yep. And then also, how do you drive domestic demand? So China's growth predominantly has been exporting stuff to the world. Once you get that internal engine, which they have been as people have been migrating from farms to the city and stuff like that, that thing is going to continue and continue and continue.
Yeah, I mean, look, political shift. So moving over to Japan, which more of a good news story rather than anything that's hugely different from an economic standpoint. But they elected their first female prime minister.
Andrew, can you pronounce her name?
No, that's why I handed it over to you.
Sene Takaichi.
Not bad. I don't know. We'll ask our Japanese listeners and viewers out there whether we've completely butchered it. But
so she is a market-friendly conservative, expected to boost spending, including defence, which I think is probably a bit of pressure from the United States, but especially including defence, and increasing that from 1.2 to 2% of their GDP by 2027.
Yeah, which is obviously supportive of growth, but it also adds to Japan's already very high debt levels. So I guess we'll have to see what happens from that perspective.
Play it out, but they're pretty positive about it. They've turned a new leaf, so hopefully she can make some moves and get things happening in the right direction. Andrew, from a commodities market, we've seen oil prices surge.
Yep.
What are we up? 5.6% to $62 a barrel. And that follows US sanctions on major Russian producers as well too. So obviously the whole oil game, oil comes from all over the world. You've got producers from different regions, different countries, and supply makes a major impact to what the price is as well too. So they do increase and decrease supply to be able to keep the price at a certain level.
Yeah, and I mean, when we're talking about commodities, I don't think I've ever spoken to people more about gold. It's dropped 5.4% now in the last week. That's the sharpest fall in 5 years. But when you look at it on a year to date, it's still up 57%. So we've seen a huge surge in gold prices. It's probably more volatile than it ever has been. So gold has always historically been a great store of wealth, and you didn't see any major fluctuations in gold. Yeah, I mean, when you start, I don't want to say that it's a bubble. That's not at all what I'm saying. But when you start seeing lines at the front of gold mints to purchase gold, like you do when you see, new products come to market and things like that, it usually causes some concern. So that's the only thing that I'll throw into the mix there, and it starts to lose its value from a, commodity and a storage of wealth perspective, because now you're starting to just see big fluctuations, but nonetheless, I mean, 57% year to date is unbelievable.
Yeah, it just becomes speculative if people are lining up. I mean, interesting fact, I think it was Costco in the US. So Costco sell absolutely everything. They sell bullion as well too. So they were running out of bullion and trying to figure out how they get their hands on more of it, because people were going to Costco to buy bullion. But Andrew, rare earths, we did talk about the deal between Australia and the US, $8.5 billion joint deal between the two. Really, from the United States perspective, they're trying to secure rare earths. I think it's like 85% of the world's rare earth are controlled or coming out of China. So the US obviously needs to find another avenue for that, which is the reason why Trump and Albo are now sort of best mates. And everybody remembers that meeting where Kevin Rudd was in there. Yeah. He was saying that he doesn't like that guy because he said something bad about him. I'm surprised he didn't boot him out of the meeting, but interestingly enough, Australian strategic materials surged 20% on the news while the US peers fell. Obviously, that makes sense because, $8.5 billion will do that to a share price.
Yeah, absolutely. And look, only a positive for the Australian economy, right?
Yeah, look, absolutely. I mean, everything that helps, let's face it, our country has been built on digging stuff out of the ground and sending it overseas. Rare earths is not as simple as, say, iron ore, where you just dig it up and chuck it on a train, get it to a port and ship it. There's a lot more processing and stuff. But, really good sign for the mining sector of the country that's exposed to rare earths. And it's only getting bigger and bigger in terms of greater and greater demand when you think about all of the tech that's going everywhere. Cast your mind back to global supply disruption during COVID and the shortages with cars. It's because they couldn't get the chips. And if you take one step back, they couldn't get the rare earths to the chip makers to be able to get the chips to put them in cars. So there was a car shortage.
Yeah, exactly. Bills, I think that covers it really nicely. Hopefully that's given our viewers and our listeners a bit of a understanding around what's been happening in investment markets over the course of the last month.
No worries. And if you got a fair bit out of that, feel free to reach out to Andrew and myself if you want any more information or want to have a chat. Like, subscribe, share with your family and friends, and we'll catch you on the next one.
Thank you.
Thanks. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.